good afternoon. My name is Noormizatul and Navila binti Ishraq. My student ID is 2023159453. Today, I'm going to explain a fundamental concept in 10 Advanced Edition, Text 667. A club is a non-profit organization formed by a group of people who come together for a common interest, whether social, recreational, sporting, or even educational. Example includes of course club, fitness clubs, cultural clubs, and alumni associations. Unlike a company or a business, a club is not set up to make a profit, but rather to provide facilities and services for the benefit of its member. Let's look at the main characters that define a club. It is a formed and controlled by a members, and it is also the non-profit in the nature. Also, its activities are for members only. The keys of features of a club is does not normally engage with the general public like a commercial business. So, for example, if a tennis club only serves its member and collects subscription fees, it operates under the principle of mutuality. I will go through some real-world examples of clubs and how their income might be treated for tax purpose, based on the principle of mutuality. Let's begin with the golf club. A golf club is a classic example of a mature organization. Members pay entrance fees and annual subscription to use the golf course and facilities. Now, income collected from members, such as for membership, golf games, or international tournaments, is generally non-taxable under the principle of mutuality. However, if the club rents out its facilities to the public or hosts events where no members participate, the income becomes taxable. Next, we have sports and fitness clubs. This includes swimming clubs, tennis clubs, or gym associations. Again, income from members using the club for personal health or recreation is non-taxable. But if the club offers day passes to outsiders or charges non-members for coaching, that income falls outside the scope of mutuality and it's become taxable business income. For social and cultural club, then we have social and cultural clubs, such as the Rotary clubs, Lions clubs, or university alumni clubs. These clubs are typically non-profit and exist to serve the interests of their members or the public through charitable events. If they receive donations or member contributions, that income is not taxable, but income from selling event tickets or renting event halls to outsiders may be considered taxable. Another example is recreational clubs, like country clubs, yacht clubs, or even hobby-based groups like photography or chess clubs. These clubs often provide a mix of service, some purely for members, others open to non-members. So again, any member based on base income is exempt, while commercial for non-member income is subject to tax. Let's quickly go over the key features of a club in the context of taxation. A club is defined as a non-profit association formed by individuals who come together for a common purpose, like sports, recreational, or social activities. There are four main features that distinguish a club. Member base. A club is formed and run by its members for their own benefit. Second, non-profit nature. It does not aim to make a profit like a business would. Thirdly, mutual activities. All facilities and services are primarily meant for members only. Fourth, internal control. The club is managed by a committee or board elected by its member. These features are important because they determine whether the club qualifies for tax exemption on member-based income under the principle of mutuality.
I would like to explain whether clubs are subject to tax in Malaysia. Yes, clubs are subject to tax in Malaysia, but they are not taxed in the same way as normal business. This is because most clubs in Malaysia operate as non-profit organizations. Their main purpose is to serve their members, not to generate profit. As a result, clubs are generally not taxed on income received from their members. However, they are taxed on any income that comes from non-members. For example, if a club provides service or hold events for the public, the income earned from those activities is taxable. In conclusion, while clubs do enjoy some tax exemptions, they must still pay tax on income earned from non-members. Next, I will present how clubs are taxed under the Income Tax Act 1967. Under this act, clubs are only taxed on income that comes from non-members. This is governed under Section 3 and 53. For example, renting out club facilities to outsiders, selling food or drink to public, hosting public events where the tickets are sold. In short, if the income is from the members, it is considered as taxable. The last one, let's look at why income from members is not taxable, and this is due to mutuality principle. The principle states that a person cannot make profit from himself, meaning a club which is seen as a group of its members and cannot profit from its own members. So, any income from members is not taxable. This applies to membership fees and internet services such as food and sport activities offered to members. For example, if the club collects 100 ringgit from members, it is not taxable. But if the club earns 500 ringgit by renting to outsiders, then it is taxable.
Let's begin with members' income, which is one of the main sources of income for clubs. This refers to any income that a club receives directly from its own registered members. These are individuals who have paid to join the club and are entitled to use its facilities. So there's some common examples that I can explain to you, which the first one is entrance fees, which the paid when someone first joined the club, and then the annual subscription or membership, monthly membership fees, which requiring charges to maintain active membership, and then users fees for using club facilities like swimming pool, golf course club, and then tennis courts and others. So the last one is participation fees for internal events or competition organized by the club for its members only. Now, when it comes to tax treatment, income received from members is not subject to tax because the reason is based on the principle in tax law that called the mutuality principle. So under this principle, a person cannot make a profit from themselves. Since the members and the club are considered part of the same entity, any payment made by a member to the club is not seen as income in the traditional sense, because it's just a money circulating within the same group. Therefore, it is not a gain that can be taxed. Because in Malaysia, this concept is reinforced under Section 53E of Income Tax Act 1967. So, which specifically provides tax exemption for mutual income received from members. So, this exemption ensures that non-profit clubs are not unfairly taxed on their internal activities, as long as the income is strictly from their members and not from outside parties.
Income from non-members. Non-members are the persons who are not entitled to vote at general meeting of the club and society. Club generally form not with the aim to make profits. It may receive income from activities or transactions with non-members which are taxable income. The example of the income from non-member is: first, proceed from fundraising drive to public. Examples: sale of homemade cookies or handicraft. Second, fees received from hiring out the club, halls, facilities and equipment to the public. Third, amount paid by non-members to attend dinner, social function, talks, presentation and workshop organized by the club. Lastly, trading activity such as restaurant, bar, entertainment outlet, gymnasium and others derived from members or non-members within the club premises are profit and subject to tax. As income from members are exempted under Section 55A, subsection 2, the computation of adjusted income from non-members would be as follows. First, we must calculate Section 4A business income, which is gross income from non-members deducted by revenue expenses, which is outgoings or expenses incurred by the club, where the formula is A times B divided by C. A is amount of outgoing or expenses incurred by the club in the basis period of assessment. B is gross income from transaction with non-members incurred by the club, and C is gross income from transaction with board members and non-members, and we get adjusted income. After that, the amount of capital allowance deductible from the adjusted income should be determined with following formula: D times B divided by C. D is the capital allowance allowed to the clubs. B is the gross income from transaction with non-members, and C is gross income from transaction with board member and non-members. Finally, we get the statutory income. Approved donation, section 44, subsection 6. Approved donation are entitled a deduction up to 10% of aggregate income from the club and society. Amount of donation must follow the following formula: G times H and divide by I. G is the cash donation under section 44 subsection 6. H is the aggregate income from transaction with non-members, and I is the aggregate income from transaction with members and non-members.
Next, we will look at investment income, which is a completely different type of income for clubs. Unlike members' income, this refers to income earned when the club use its surplus fund, which are not immediately needed for operation, but it will invest in various assets. For example, there's a few examples that I can give for investment income, which the first one is interest income, where from testing surplus funds in fixed deposits or savings accounts. Second, rental income. If the club owns a property or space that it rents out to other parties, it will declare as a rental income. And then the third one is dividend income, earned from shares or equity investment in companies, then it will be declared as a dividend income. The last one is gains from disposal of asset. For instance, if the club sells a property or investment and makes a profit, and then the amount will be declared as a gains of from disposal of assets. So now, in contrast to members' income, investment income is taxable. That according to the Income Tax Act 1967, investment income is classified as income from other sources and is specifically governed under Section 4C of the Act. So this is because the income is derived from external sources, and the mutuality principle does not apply in this act. So in this case, the club is seen as engaging in income producing activities that are not internal or mutual in nature. So it is important to note that even though the club may be non-profit in nature, any income derived from investment, especially when those investments are outside of the club's normal member or that based activities, is considered a separate stream of income, because that must be declared and subject to income tax. So hence, club must keep clear records to separate members' income, which is exempt, and investment income, which is taxable, to ensure proper tax compliance. That's all for the part of type of income.
Assalamualaikum. My name is Siti Nur Hafizah, and now I will briefly explain about the tax filing requirement for club and association in Malaysia, which is based on the guidelines by Lembaga Hasil Dalam Negeri. Alright, first of all, even though we knew that most clubs are non-profit, they are still required to register with HDN, especially if they earn any taxable income. This include income from non-members like rental of facility, ticket public event, or investment income such as dividend or fixed deposit interest. Next, the type of tax form that need to be submitted is depend on the nature of the club's income. If the club does not run a business, then they should file Form TF, which is due by 30 June every year. But if the club operates a business or earns significant income from outsider, then they should file Form C, which is the deadline is 7 months after the financial year end. Form TF is much more simpler and applies to non-business body. Meanwhile, Form C is for clubs that operates more like a company. Before submitting the tax form, the club must prepare supporting document such as audited financial statement, a clear breakdown of member and non-members' income, a detail of any donation or investment income such as rental, dividend or interest, and if Form C is used, a tax computation worksheet is also required. All of these forms must be submitted through e-filing using LHDM My Tax Portal. It is also important to know that clubs must keep accounting record for at least 7 years. Income from members like annual fee or club activities is generally not taxable, but income from non-members is taxable, so it must be recorded separately. In conclusion, all clubs and associations must fulfill their obligation by submitting their Form C and Form TF, depending on their activity. Proper segregation of income and complete documentation are the key to staying compliant with LHDN regulation.
As we know, income generated between members are not taxable, while income arising from non-members are taxable. The same cases with losses. As the income are disregarded, the losses are the same case. We cannot deduct losses from members' transaction to income from non-members. For the case for non-members, any losses is to be carried forward to the subsequent year to be offset against income from the same source.